There, everyone. Welcome to today's program. I'm your moderator, Dara Albright, co-founder of D-Wealth Education, and that is the educational division of Digital Wealth News. Today marks the official beginning of D-Wealth Ed, a new fintech educational initiative that provides incentivized learning to financial professionals, business executives, and modern-day investors/consumers. Yes, learning just got lucrative. We could not be more excited about launching this program with Sarson Funds, an independent provider of blockchain technology, cryptocurrency marketing, and educational services. Today, we proudly present part one of an 8-session course called Digital Asset Investing in the Blockchain Technology. The first session is titled Introduction to Blockchain Technology and will provide a comprehensive primer into blockchain technology and some of the new asset classes it has inspired, such as utility tokens, stablecoins, privacy coins, smart contract coins, and such. Today's distinguished presenter is Jahan Jamali, CMO and co-founder of Sarson Funds. Jahan is a leading expert on emerging technologies, global risk management, and international relations. He is a renowned digital assets and crypto educator and former U.S. intelligence officer. Very excited to have you on here today, Jahan. And before I hand over the mic to you, just a couple of housekeeping items for everybody that's listening. First, the webinar will last an hour. It'll be 50 minutes of presentation, and then the last 10 minutes will be Q&A. If you have questions, feel free to type them into the chat, and feel free also when you type them in to use a question mark, because that'll help us decipher between a question or just a comment. But please know that we're not going to be answering the questions till the very end. For those who qualify, Investments and Wealth Institute has accepted today's webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certification. You could feel free to visit investmentsandwealth.org to learn more about the certification program if you need to. In addition to CE credits for financial advisors, webinar participants who complete the entire 8-part course will also have an opportunity to earn Sarson's groundbreaking new crypto advisor certification. And you'll learn a little bit more about that today as well. With that, I hand the mic over to you, Jahan. Looking forward to the presentation.
Well, thank you very much, Dara. And I'd like to start off by thanking our folks here at Digital Wealth News, Dara Albright, Cindy Taylor, and others that were so gracious in helping us host this program. I understand that there's a lot of folks from a very different levels of cryptocurrency experience and background here on the webinar today. So I want to give you all, before I really dive into it, just a bit of a caveat as to what you can expect. You know, we have this 8-part program, and this is really designed to give you a baseline foundational understanding of blockchain technology and cryptocurrency. And this particular session, our first session, is an introduction to blockchain. Now, some of you on the webinar might have a good deal of experience with cryptocurrency and blockchain technology. And this might seem, some of the material here might seem basic at its heart. However, I want you, for those that have a bit of a crypto experience, to really focus in and key in on the way in which we introduce the material and the way in which we explain it. I spent the first part of my career as a U.S. intelligence officer training folks on concepts and understandings and belief systems that were a bit foreign to them initially. So one of the ways in which we designed the course was not just so that you, the attendee, could understand blockchain and crypto and digital assets, but that you would feel comfortable explaining this material to somebody that had no knowledge of it yet, or was just at the beginning part of their learning curve. Because after all, money's a belief system, and no one wants to be taught a belief system. They need to find out where their origin point of their discovery process begins. And that's how we designed this course. So without further ado, let me roll right into it, because I'd like to get you guys conceptually oriented as to where we're going. Now, blockchain technology, right? Everyone has heard of blockchain or knows that it's something that has really struck a chord amongst not only financial professionals, but computer programmers. And this ostensibly is where the worlds of Silicon Valley and Wall Street have finally converged to a degree. But it's much more than that. Blockchain technology is really it stands to solve the global trust deficit. We live in the era of fake news. We live in the era where information is at your fingertips. Validity and trust, however, are not so easily discovered. And to really understand where blockchain technology fits in and how blockchain is not Bitcoin and that's not, blockchain is not crypto, and understand that blockchain is the technology behind those things, is to really have a good understanding of macroeconomics, finance, international relations, and computer programming. So part of the reasons why blockchain is changing the world is that, as I was saying before, it's solving that global trust deficit. Blockchain data can't be modified or altered. It's immutable. I want to talk about that a little bit further on. Blockchain also provides a level of transparency into data that is that before wasn't really available, especially when it comes to payment networks and fraud prevention. Blockchain's efficient. We're going to talk a little bit about the differences between a centralized and decentralized architecture and how the efficiency is really brought to light and brought to the surface with blockchain technology and distributed ledger technology. It's also protective, right? With that level of transparency and with the level of security, there's a new level of confidence that's established in terms of data protection. We don't go another like 2 or 3 days in the news without seeing some type of news story about a system being hacked. And at the end of the day, we've transitioned over the years from a hard cash system to a digital cash system, and payment networks and buying things on your phone. That doesn't serve well for the continued trust if it's a centralized architecture that your data and your finances are at risk. So we're going to talk about how cryptography and algorithms deliver a new level of security with blockchain technology. So why blockchain? Right. Well, we talked a little bit about that previously, and we live in a globally interconnected world. And their transaction levels are becoming increasingly complex. In a centralized record-keeping system, data integrity is more prone to human error, more prone to hacking. We'll talk about why in a little bit. And with the growing level and growing size of our human connected network across our finance systems, across our e-commerce systems, across systems like this, where I can sit here and have a conversation with you today, speed is important. Validation speed is important. But really, what makes blockchain so unique? And this is where I really want to get into the nitty-gritty here. So blockchain stores information badges, and those are called blocks. And they're linked together in a chronological way to form a continuous line. So metaphorically, it's a chain of blocks. If you make a change to the information recorded in a particular block, you don't rewrite it. Instead, the changes are stored in a new block, showing that X changed to Y, and it's also gives the particular time and date. So if that sounds familiar, it's because blockchain is based on a centuries-old method instituted by the Medicis of the general financial ledger. It's a non-destructive way of tracking data changes over time. But rather than just debits and credits and changes and alterations, it's a triple ledger accounting because it adds the date timestamp that can't be changed either. So here's where things get interesting as well. In an old ledger method, those types of entries, when they're booked, are then added as a database on a single system, on a single centralized system. That's typically how we've been doing things the last couple decades. However, blockchain was designed to be decentralized and distributed across a large network of computers. This decentralizing of information reduces the ability of data tampering. And that brings us to the second reason why blockchain is so unique. It builds confidence in the data. Trust is built into the protocol. So before a block can be added to the chain, a few things have to happen. First, a cryptographic puzzle must be solved. And that's creating the block. The computer that solves the puzzle shares the solution to the network, the computers on the network. And that concept is called proof of work. We'll talk about that a little bit later on. The network will then verify that proof of work, and if it's correct, the block will be added to the chain. So this combo of complex math puzzles and verification by multiple computers ensures that we can trust each and every block on the chain. Because the network does the trust building for us, we actually now get the opportunity to interact directly with the data in real time. And that brings us to the third reason why blockchain is so unique, and really why it's such a game changer, is that because trust is built in this decentralized network, it reduces or eliminates the need for intermediaries. That's really big. If you think of every type of computer process or contract process that you've experienced, there's always been some sort of intermediary. It's even changing the very nature of banking, right? There's a trust concept called a trusted third party. If you use a trusted third party, if I want to send some money to Dara, the institution in the middle needs to verify that I have the money to send, and then release that, and then verify that Dara has received it, and then debit that from my account. Well, it's a lot of work, believe it or not, to have that additional layer on every single type of transaction that happens in the world today. Even from something as simple as a simple money transfer to a complex contract. These layers of intermediaries are going to change, and they're going to change in a way which is going to create an enormous amount of efficiency with blockchain technology.
I'm going to just take a quick poll here. You're welcome to answer some of those questions. We'll get a little bit of an idea of how familiar everyone is with blockchain technology.
Well, now that I've sort of talked about some of those higher level concepts, without getting too technical, let me walk you through effectively how a blockchain transaction would work, so you have a little bit of a visual to go along with what I just explained. So when a transaction is initiated, it's grouped together with other transactions, and that data is packaged up in a block. That block is then sent to members of the network, and through a consensus mechanism, and there's a few of which are known or popular today, proof of work and proof of stake, and I'll talk about those in a second. But through that consensus mechanism, approval and validation of that transaction is competed for. And then once its consensus has been reached, that block of data is added to the chain. And once it's added to the chain, then it's distributed to the whole network. So there's a few key terms and concepts here. One is block size, or blocks. So they come in different sizes depending on how many transactions can be stored. Two is consensus. And that's really that element that makes blockchain so unique, is its ability to confirm transactions without the need for a third party. Now, you probably heard about the term hash rate. You don't need to know a lot about hash rate, and ostensibly what you want to understand is that that's the speed at which transactions can be validated. And the more computers you have in the network, the more changes you're going to have in that hash rate, and the more secure the network will be. And of course, that brings us to security as well. And I'm going to talk about how this type of distributed architecture actually yields far greater security in your transaction network and in your computer systems. So on the left here, that's a centralized architecture. That's effectively what we've been utilizing now for the last several decades on every computer system you've ever used. There's a server, and computers are connected to that server. And they communicate and they talk in that server, and that's where the applications live, and that's where the validation occurs. Now, the problem with that is that as networks grow, and now the world is a lot different now than it was 20 years ago, where you go online for like a few minutes a day and check something maybe right when the internet came out. Like now you're online all day. all day, every day. You're online on your computer, you're online on your phone, right? You're constantly interacting with the internet, and there are a constant level or a constantly increasing level of interactions and exchanges and transactions that are happening. And that rate of which that is increasing is not going to slow down. So this type of centralized architecture is really inefficient. It's also very, very dangerous. It's a single point of failure. You see this all the time with hackings and ransomware, that if you have a centralized system, you start to limit the ways in which you can protect yourself. You have that one part that is really the most vulnerable. And with that pipeline hacking, all you had to do was get into their single server, and then you had the keys to the kingdom. It also provides limited transparency. And I think that as folks have more access to different types of information than ever before and want to take ownership and have a level of data self-sovereignty, limited transparency is simply not going to cut it. Right? Limited transparency means that only a certain amount of folks or certain folks with certain privileges can see certain things, and that can be reduced and limited even further. Now, with a decentralized architecture, using that transaction process I explained in the slide before, it's far more efficient in terms of the amount that you can process. You don't have that middle layer. There's no single point of failure, and that makes it highly secure and much more resistant to data breaches and hacking and malware. It's also highly transparent. I'll talk about Bitcoin in a little bit, but Bitcoin is the most transparent payment network in human history. And that doesn't mean that necessarily that you can see somebody's like address and real name and things of that nature. Now, there's different rules for different blockchains, but at the end of the day, blockchain is a highly transparent methodology and architecture that allows for fraud prevention and prevents, and for anti-money laundering activities than we've ever used before. And I think that's really important and critical to know, especially as a financial advisor, right? Nobody wants to be, knowing that they're dealing with dirty money or money that's, has a criminal element to it, or that, goes on a pipeline for, terrorist funding. But at the end of the day, cryptocurrency, as long as you are doing your proper KYC and AML, and we'll talk about this a little bit more in a later session, provides you with a level of transparency that otherwise has not yet been afforded yet. And through that, a lot of confidence and trust is built. As a former intelligence officer, I can tell you straight up that this is a fantastic way with amazing potential to make us a safer, more secure, and more open society all at the same time. So let's get to crypto for a minute. Now you get an understanding of blockchain technology. Cryptocurrencies are blockchain technology's first killer app, is a good way to think about it. And there's a variety of different cryptocurrencies, and we'll talk about some at a high level here. But that's the core difference, is cryptocurrencies are built on using this type of technology called blockchain. Now, I get this question often is, well, what's it backed by? How do you get value? How do you determine its value? Well, there's a couple concepts I want to talk about so that you can get a better understanding of where that value is derived from. Money, at the end of the day, or the value of money, in part, is relational to your ability to keep it safe. If there were no safes and you had a bunch of gold and you had no way of protecting it, and nobody did, that would certainly affect the value. So why banks were born to begin with. Same thing with your digital money now. Most of us have money and it's reflected in our bank account as a entry on a server somewhere. But as the ability to keep that safe and secure starts to wane, it affects the value. So part of the value that underpins blockchain or underpins cryptocurrencies that are built on blockchain technology is that ability for security and trust to be built in. Now, the second way is through the unlocked efficiency. There are some studies that are estimating up to 95% of the global transactional overhead could be reduced or eliminated with blockchain technology. That in and of itself has just unlocked an enormous amount of value. Also, value through exchangeability. One of the core requirements of at least the currency type of crypto is it needs to be transacted. You have the ability to transact for a good or a service. You can certainly do that. Not only can you transact for a good or a service in a variety of different ways, and we'll talk about that here in a second, you can also convert to other types of currencies across the crypto ecosystem, and even to fiat U.S. government or other types of government central bank currencies. So its exchangeability as well provides an enormous value. Now, one of the things that I like to really make a distinction with is these aren't stocks. Stocks have, unless there's a split, they have a fixed amount of shares. And there's different valuation models that I'm sure you guys are all very familiar with on stock valuation. These are networks. And when you want to think about the value of a network, you need to not just look at independent price action. You need to look at something called Metcalfe's law. Now, Metcalfe's law, I'll give it to you really in just an easy way to sum it up. Metcalfe's law is that the value of a communication network or any type of network, telecom, financial network, the value of a network is proportional to the square number of its users. So this law is true for any type of comms network, whether it involves computers, telephones, or internet users. And while the notion of value is a bit vague, the idea is that a network is more valuable the more people you can call or write to on it. So let me give you an example. I give this example all the time. So say you lived in the world where there was the first cell phone, or the very first phone. It was expensive to make, but there were no other phones in the world. So that basically renders it useless and valueless. Now, if I had a second phone, someone else gets a phone, now I can call them. Now the network of two has a value of effectively two. Now I add a third. Now all of a sudden, I raise the value of that network exponentially. So take that up a notch, and you can see a similar growth trajectory in some of these types of assets as you had the historical growth trajectory of the fax machine, or the telecom, the phone system, or even the internet itself. And one of the things I want you to think about is, we're talking across the internet now. The internet has allowed us, not completely in a decentralized way, because we have a lot of centralization here on the internet, but has allowed us to share, access, and distribute information more or less freely, at least in the Western world, more or less freely across the globe to more people than we ever have before. Right? This is why we're sitting here having this conversation today. But what blockchain technology and what cryptocurrency allows you to do is to not only transmit info. Now you can transmit value. I can send $5 worth of cryptocurrency to somebody sitting in sub-Saharan Africa, but maybe that person doesn't have access to a bank, and if I was going to send them a wire, it wouldn't make sense for me to send them $1. Right, the cost of transaction would be too high. That paradigm of challenges doesn't exist when you look at a world that's powered by digital assets. Now all of a sudden you can look at our ability to send value across the globe anywhere we want to, as a way of almost completing the internet, if you want to think of it like that. So let's roll into it a little bit more. So cryptocurrencies. So what are they? Very firmly and squarely, they are a new asset class. The Federal Reserve has recognized them as an asset class, and nation states now are recognizing them as an asset class. Japan has, before El Salvador came out with their announcements, Japan recognized Bitcoin as legal tender. Wasn't one that was necessarily official in the country, but they did recognize it. And now you have nation states that are actively, adding it to their ledger, adding it to their books, or declaring it, legal tender as well. So they're here, and they're an asset class that you should get familiar with. They're also solving real-world problems. Time Magazine called Bitcoin a powerful force for freedom. And in that example I just explained, as sending crypto assets to somebody in maybe a undeveloped region of the world, there's over 1 billion people in the world that are unbanked. What do I mean by unbanked? These are folks that don't have access to the financial system like you and I do, and that you and I ostensibly probably take for granted. These are folks that either they don't have the $50 or the $100 worth of whatever their home nation's currency is to open a bank account, or they live in a despotic regime, or they live in a country that the economic situation is just too chaotic and too unstable, like a Zimbabwe or a Venezuela. And these are folks that they've been locked out. That's over 1 billion people. This is bringing the banking to the unbanked. I've said before in a few of my other programs, dictators hate crypto. Of course they do. It's a powerful force for freedom. And it's a way in which folks can access, and store and save in a way that was, up until now, completely foreign to them. In El Salvador, as an example, they were on the dollar system, but, a good deal of the El Salvadorans didn't have a bank. It was dollars in a jar underneath their mattress. You know what everybody has, for the most part? Everybody's got one of these. They got a phone. Now they have a savings mechanism where they never otherwise had one before. And a savings mechanism that was untethered necessarily to, political shifts. And cryptos are seeing rapid global adoption. Wall Street and financial leaders like Goldman, Fidelity. Fidelity has its own giant, division dedicated to cryptocurrency, Fidelity Digital Assets. B of A has explored it. JP Morgan, despite Jamie Dimon's initial resistance and hesitancy, has gone about and created a division dedicated to investment strategies. They're here. Wall Street's starting to embrace it. Regulators are starting to embrace it. And it's something that, as a wealth manager, you need to understand. Because at the end of the day, blockchain can solve the global trust deficit, but Americans trust their financial advisor. This is really an opportunity for folks in the wealth management industry to be a hero and to be that person. Like, I'll tell you right now, my father, who's a business owner and is getting close to retirement age, he's not putting 50 grand, 100 grand on something on his phone, but he's going to go ask his financial advisor. Right? There's thousands of cryptocurrencies. He doesn't know which ones, and he doesn't want to have to get into the weeds, but he's going to want to ask somebody. He's probably going to ask his financial advisor. So this is your opportunity, wealth managers, to really shine here and to be that beacon of trust for your clients that are going to start to ask about digital assets. So let's talk about Bitcoin for a minute. Bitcoin, the first cryptocurrency and the largest. Born out of a crisis. I'm sure that most of you have an understanding of Bitcoin's origin story. That it was born out of the 2008-2009 financial crisis with a white paper called Bitcoin, a peer-to-peer electronic cash system. And it was written and authored by an individual or a group of individuals that have decided to stay anonymous under the name Satoshi Nakamoto. But Bitcoin's open source. And once that first transaction happened, which was originally for some pizza, then it planted a seed. It achieved that last element of what it needs to be a currency, right? What it needs to be a currency, you need to have some element of rarity. You need to have it, the people that are on the network trust and understand that, I'm going to transact with it. They have to have an element of trust, and it needs to be in circulation. And that first transaction put it into circulation, and it's grown exponentially from there. Now, Bitcoin has a finite supply. It's dripped out over a long period of time, and the algorithm, if you really want to get into it, if you're a math geek, is written in the white paper. But there's 18 million in circulation, roughly. There's only going to be a total of 21 million. It's only 3 million more. And it'll be a couple hundred years before that 21 millionth Bitcoin is finally mined. It's rolled out sort of in a reverse curve. And part of Bitcoin's appeal is not only was it the first and original, but it acts as both store of value and has transaction capabilities. And as it's grown over the last decade, it's developed an enormous amount of liquidity. All right. So there's lots of different types of digital assets. So let's walk through some categories here, just so you get an understanding. There's been, proposed legislation that has tried to categorize these. I think regulators are still trying to figure out where they fit in certain sleeves. But let me walk you through a few of the core categories. There's security tokens. Security tokens are tokens that represent a tradable asset that exists also in the real world, so to speak. So that could be stocks, that could be a real estate, like a real estate investment trust or a limited partnership that can be represented on a blockchain rather than represented on just like a simple piece of paper, really, that has no liquidity and that has all sorts of different steps involved in order to expand liquidity or to make changes. So these can be represented in the form of a digital asset, and those are security tokens. Utility tokens, right? So utility tokens help or validate your ability to use a particular service or function. And you could look at ride sharing capability as one potential user of utility tokens. Now there's smart contracts. So we'll talk about Ethereum in here in a little bit. One of the core differentiators on smart contract platforms like Ethereum is that it's not solely for making relatively simple transactions, like I send money to Dara, she sends it back to me. It allows you to put conditions on those and allow you to put quite a bit of complexity into those conditions. So you can create effectively a smart contract where, if I'm going to loan something to Dara and payment needs to be at this certain rate on these certain days, you can add that level of complexity in there, and through that you can build different types of applications on these protocols. You also have stablecoins, and these are digital assets that in some way, shape, or form are pegged to an existing fiat currency. There's a handful of dollar stablecoins or to other types of assets like gold. There's privacy tokens, and I don't believe that the privacy tokens have too much of a life here in the United States, because those are designed to obfuscate origin. Like I said, Bitcoin is the most transparent payment network in human history, and I suspect that some of the real hardcore privacy tokens are going to run into issues with regulators, but we'll see how that plays out. But you should be aware of them. And of course, we have NFTs. These are non-fungible tokens, and they represent either ownership or participation in a community, and you can deploy them out as art. Think about it if like a customer rewards card. I always felt that if the blockchain would really see large-scale adoption once consumer rewards programs started to reorient themselves as a digital asset. That value is already there. Think of it like your CVS card. Every time you use it, you get spit out probably 3 miles worth of paper receipts. That's value that, like, ostensibly doesn't even get all used. It almost goes to waste. Now imagine if you could represent your membership to a club or a rewards program in a digital function. That could be incredibly powerful in terms of community capabilities, as well as for getting value out of your membership. And we've seen a lot of celebrities that have fan clubs. We've seen a lot of professional athletes that want to find different ways to monetize and find different ways to interact with their fan base, do it through NFT platforms. And we've of course seen this with art as well and tradables. So this is something you should be very much well aware of. And as a matter of fact, those that complete the whole program here with us and go through all 8 of our sessions are going to get their certificate of completion, not only in a hard copy, but in a digital format as an NFT. So that'll give you some real hands-on training on getting familiar with them. So I do want to talk about some differences amongst types of cryptocurrencies, right? These are some of the core differences that you'll see across the board. I've given you a little bit of a backdrop into some of the categories, but I think it's important for folks to understand what the differences are in terms of their function. So there are those with a fixed supply, and there's a handful. Bitcoin's one of the most well-known ones, has a fixed supply. You only have 21 million of them. Now, I should have mentioned this earlier, but I'll mention it now. That doesn't mean that you can't buy it in fractions. And for those of you that aren't aware, a fraction of a Bitcoin is referred to as like a Satoshi. So just like dollars to pennies. So you can buy a fraction of Bitcoin. But there's only going to be 21 million Bitcoin ever. Now, Ethereum doesn't have a fixed supply. It's getting a bit harder to mine with some of their upgrades, and they're moving to a different type of consensus mechanism. We'll talk about that here in a second. But there are tokens that they have a difficulty adjustment in their lifespan to make it more difficult to add more, but there's not a cap. So if you have like a large application ecosystem that you're trying to build or develop, it might not make sense to have a fixed supply. Doesn't mean you're not going to unlock on value with the apps that are built upon the particular blockchain. But in some instances, it just doesn't make a lot of sense. You want to have the flexibility. So they both have their benefits. So let's talk about consensus mechanism for a second, because that's important for people to understand the difference. So different crypto assets have different ways in which they confirm their transactions. Bitcoin uses something called proof of work. And proof of work at a real high level, it's that confirming the block of the transaction requires a good degree of computing power. And computers, powerful mining computers, compete to solve the problem for every block. The one that solves it the fastest and has the correct answer gets rewarded, and gets rewarded for confirming that block of transactions. So you've heard a lot of talk about Bitcoin and the computer power that it generates. The primary recipient of some of that criticism has been proof of work mechanisms. Now, I want to put that into perspective for a minute, and we can save this for a later session, but if you were to add up all the energy expenditure of the traditional finance architecture, all your banks, all your buildings, all the computer servers, all the air conditioners, all the ATMs, all the gas that fuels the truck that carries the cash, that has the 3 guys in it with their weapons that goes back and forth, right? If you add up the entire infrastructure, it pales in comparison. It's actually about 4 times more energy expenditure in the global finance architecture as it stands now than there is in Bitcoin. So just keep that in perspective when you have that conversation. Now, proof of work also has a high level of security, obviously. It's not easy to gain control of a network that uses the proof of work mechanisms. Proof of stake is another consensus mechanism that's quite popular amongst crypto assets. Now, proof of stake, rather than having powerful mining computers compete to solve an equation, spread that burden out across its users proportionally to how many, roughly proportionally to how many of that particular asset the user has. And by putting up some of your token as collateral to participate in the consensus of transactions, you get rewarded. These are called staking rewards. So if you've looked on like Coinbase or some of the other wallets, you'll see, oh, I can earn X amount of percentage in staking rewards. What the hell is a staking reward? And I'm sure in a lot of people's minds it goes to be like, okay, that's like interest almost. Well, no, but it's not a bad way to start to think about it. It's an ability for you to earn for participating in the consensus. And what it does, it takes that power burden and spreads it across a greater network. So a lot of folks look at proof of stake as maybe a more efficient or more scalable from an energy expenditure methodology of consensus. One of the other core differences too is in their function, right? Some of these are really built for quick transactions. Some of them are viewed as a store of value, but also maybe have transactional capabilities. Bitcoin, a lot of folks view it as your store of value. It's your digital gold, so to speak. You can certainly transact with Bitcoin, but Bitcoin transactions tend to take a little bit. It's, might take 10 or 15 minutes. Someone's probably not going to stand in a line for 10 or 15 minutes, although the Lightning Network, which is a payment upgrade to the Bitcoin protocol, has made those faster. There are other cryptos out there that are really built for very quick, small transactions. Others are more utility. Others provide different levels of security. Others are built for platforms for which you can build applications on. So these are some of the differences you want to look at. It's not just that this is like another type of Forex. Digital assets represent an entire new universe, and it's a universe that a lot of folks feel our future is going to be built on these types of protocols. Governance as well. And as I was saying before, some of these have different functions, but also different governance protocols. Who makes the rules, really? Some of them are open source and have a foundation perhaps behind it. Others might be projects from a company, and that's not as many as there are open source ones, but certain companies might develop their own blockchain ecosystem with their own token so that you can build apps specific to what that company does. So these are some of the things to look for as you start to do your research. So let me walk through and talk about some different types of real world use cases. And we're going to get really into this on our next session, but I just wanted to give you sort of a high level. So supply chain management, it's sort of a natural fit. And VChain is one of them. And there's a handful of others that really enable immutable asset tracking. EHR, right? Electronic health records. There's a handful that are getting into or being looked at as ways of managing your personal healthcare data, Metablock being one of them. Telecom. Telecoin is one in particular, and that, coins that operate in the telecom industry are looking to bridge the gap between blockchain and telecom by linking billing platforms with mobile money. Let's say you're in a stadium and you're trying to make a phone call and you get one particular service, you get AT&T, and your service is all jammed up because everyone else is riding on the same network, but there's like some availability on Sprint. Now, wouldn't that be nice to be able to then quickly switch over without like a brand new contract and ride off the Sprint network where you're billing in real time those micropayments back and forth? And speaking of like microtransactions, self-driving vehicles and the Internet of Things, there's a handful of blockchains, IOTA being one we use here in this example, that are helping to power that. Now think about that, right? If you get a self-driving car, it's not that you need to know that the data from the car in front of you is valid. It's that you need to know that the data from the car that's in front of that one and the entire ecosystem around it is valid. So you have all these transactions happening in real time, lightning fast from all of these different data points, and there needs to be trust built into that protocol. As well as like maybe the ability to pay your parking, right? And pay your tolls. Metaverse. You guys might have heard of the metaverse, right? The virtual reality world that's merging with our real world, where you can build and monetize digital real estate, so to speak. That's become very popular and has an enormous amount of potential. Online advertising, right? There's that intermediary in the middle, the pay-click ads, right? And that has driven an entire business model of getting you to read stories that seem maybe salacious, or that seem maybe written in a bit of a hyperbole, or that all of a sudden you said something about a fishing pole that you were looking to buy, and then like for the next 3 weeks, you got fishing pole ads just tracking you, right? People have gotten a little bit tired of that. So there's some tokens, basic attention token from the Brave browser, that's looking to disintermediate that and pay you and reward you with their token for interacting directly with ads that you want to interact with. There's, of course, the decentralized internet, right? We talked about Ethereum. Ethereum's the second largest cryptocurrency by market cap size. There's also synthetic assets, right? And there's a handful of these in the DeFi space where it's creating an enormous amount of liquidity amongst otherwise previously hard assets and other types of financial markets. We have a whole section in one of the later sessions devoted a bit more to DeFi. Same thing with payments and remittance, faster and cheaper commerce as well as transfer agents. there's an enormous amount of real world use cases. And like I said, we're going to get into the nitty gritty of some of these and really start to explore them in our next session. So I'm looking forward to that. And we're seeing an enormous amount of institutional adoption. As I said before, JP Morgan, Fidelity, PayPal, just to name a few. And the regulatory landscape is maturing as well, right? It's not just Wall Street that's looking for education. Regulators are looking for education as well, but they know it's here. And you know, the Treasury Department, central banks, the SEC, they're all trying to figure it out. Now, one of the things that obviously comes with any types of investment is risk. So there's a high-level perspective, and we have an entire session also dedicated a bit more to risk. There's a lot of risks involved in any type of investment, but some of the ones to look for, and some of the ones that are mitigated by blockchain, right? You know, business risk. Like I said, trust is built into the protocol. Cyber and fraud risk. You know, you hear all of these stories about hacking and crypto, right? Well, you have a little perspective on some of those. Some of those are just, you know, people losing their password, or people like using not good human methods of keeping their stuff safe. It's essentially like leaving your ATM card and your PAN card just sitting on your profile somewhere. But at the end of the day, you can, you know, systems and organizations can track details. It's enormously transparent. You know, there's a, you know, from a regulatory and compliance standpoint, regulations and compliance are trying to catch up, but I think that what they're starting to understand is that there's an enormous amount of capability to offer real-time traceability into payment networks, and also put in rules in place that can prevent fraudulent transactions. You'd have to be a really dumb criminal to use Bitcoin. Like, you can't hide what you do. So, you know, cash systems are far more easier, far more prone to criminal activity. So as soon as the regulators start to figure it out more, this can offer an enormous amount of protection in terms of, you know, regulations and compliance. And, you know, like I said before, those consensus mechanisms are built upon a field of mathematics known as cryptography. And having it decentralized without a single point of failure adds an enormous amount of security to blockchain systems as well. And that's where you get the name cryptocurrency. So that brings us just about towards the end of our overview here. I do want to remind folks that you know, we do have our next session on September 28th, where we're going to talk a bit more about real-world blockchain and crypto applications. So please tune in. You'll get an email reminder and just a quick overview about our program. You know, complete all 8 sessions of the program to, you know, receive your digital certificate and your hard certificate as well. You also receive a copy of a book that we're publishing called Deep Crypto, which will give you a good overview of the space as well as some of the topics that we covered today, if you complete the 8-part series. And with that, I think it's a good idea. Maybe we can turn it over to some questions, Dara.
Presentation. I just seen this question that came in. I think is such an important question, and it asks, how does the value of existing cryptocurrencies pan out in the future with newer and competitive currencies emerging every day?
It's a good question. Well, there's a couple things to consider. As more and more cryptocurrencies emerge, it's going to be harder for newer ones to have the same type of first mover advantage as other ones did. But we're going to see an enormous amount of development in the competitive landscape. There's something to be said about getting to a critical mass point, right? Bitcoin, it took, like, you know, relatively over a decade or so, maybe a little bit less, to get to where it is now. Will it get displaced? I'm not sure. But I think that what you're going to see is more of like a stratification for different use cases in different markets. And since they all have a high degree of interoperability, it's not that one is going to displace another one. It's just another piece of that ecosystem. You know, I'm not going to buy a pack of gum with my Bitcoin. I'll tell you that. I might buy my house with it, but maybe for my small transactional purchases like that, I'm flipping it quickly to Dogecoin, right? Or maybe for my auto insurance policy, then it goes to Ethereum. You're going to have different levels. So I would say as the ecosystem develops, we're going to get an idea of what the total amount of layers are going to be.
That's interesting. What type of token or coin has more use cases? A utility token or a smart contract coin?
I guess it depends, because you can have a lot of overlap between the two. Right? A utility token can be a smart contract platform, depending on the use case, and it really depends on the market that it serves as well. Certain utility tokens might serve a limited market. Maybe they're just for a particular marketplace, or a particular sector, where it really depends on the smart contract side on how easy is it to write applications and build applications. Right? Is it a new language programmers going to use? Is it something that has easy interoperability? So it depends on a handful of things, and there's a significant amount of overlap, I think, between utility tokens and smart contract tokens.
And then can different applications of blockchain technology, cryptocurrencies work with one another? And if so, how does that work?
Yeah, quite a bit, as a matter of fact. It's rare for crypto assets not to at least have a Bitcoin trading pair. And as I'm sure you can see that for those that have a little bit of personal cryptocurrency, you can swap them back and forth and across each other. And Bitcoin, for a lot of purposes, sits in the middle of a lot of that. For the DeFi space, Ethereum sits in the middle of that. So we're starting to see that play out, where you have this ability to utilize one of the major cryptocurrency platforms as your method and pathway for interchange and exchanges.
So I thought this was an interesting question that comes out. When do you think we'll start to see investors who disregard capital gains taxes in crypto and NFTs start to get pinged by the IRS?
Well, that's a good question. I think that regulators are still working to define the rules. And I think that we're going to have to see the regulatory bodies understand it better for themselves in order to then be able to figure out how to tax these appropriately. We have measures in place. I'm not sure if they're adequate for what the future is going to hold. We're just going to have to see. But at the end of the day, you should have a good understanding of at least what the current regulations are with regard to cryptocurrency tax implications. Because, like I said, it's transparent. At some point in time, the taxpayer is going to catch up.
And how about just regulations in general? We're getting some questions regarding that. If the regulations then start seeping into cryptocurrencies, how will this differentiate the existing fiat currency and its problems from the cryptocurrencies?
Well, we're starting to see more exploration in the central bank digital currencies. And I think that the decentralized space has really pushed that argument forward. But ostensibly, politics is a function of influence. And you got to ask yourself a little bit, who's influencing certain politicians? Large-scale financial institutions that have a lot to lose. And I think that if they reoriented themselves a little bit, they would understand that if they were to pivot appropriately, they actually have an enormous amount to gain. But like any type of tectonic shift like this is, it's not going to come without challenges.
And what do you think of Visa buying an NFT?
Oh, I think that's great. At the end of the day, what is Visa?
Right.
Visa is a payment network. And Visa and MasterCard are very well aware that if they don't start to understand and integrate blockchain and crypto, that their payment network and that merchant service fee of 5% on every transaction, or whatever it is, 3 to 5% on every transaction that the merchant gets charged, and like your annual fees, all of a sudden that's the target that's the target that cryptocurrencies are looking to disintermediate, are those types of transactional charges. If you really want to know where the value of crypto is going to come from, it's going to come from sort of disenfranchising and kicking those to the curb. So I think it's a really smart move by Visa to start to get into this.
You talked a little bit before when you were talking about Bitcoin. Do you think it's possible that Bitcoin could become the new gold standard? Moving us into a new, where basically it is the new support for fiat, even all over the globe, backed by Bitcoin instead of gold?
Yes, it certainly is possible, and could be very well likely.
What industry do you believe could benefit the most from blockchain technology that either hasn't already adapted to it or has adapted just on a very small level? Interesting.
Auto. Cars, absolutely, and all facets of your purchase, of your validation of its history, from your insurance claims to your financing, to your loans, to your aftermarket sales, to how a dealership operates, to all sorts. But like your transportation in general, I think is enormous. And I had a lot of experience in automotive technology in my prior life. I think automotive is one of those verticals that is just starting to figure this out. Like, how about your car registration? Like, anyone experience any time at the registry motor vehicles can probably sympathize with this. But even from like your loan applications and to loan repayment, I think it has enormous.
That's really interesting. And what about, you had talked a little bit before about proof of stake versus proof of work. Do you foresee Bitcoin going to maybe more of a proof of stake consensus mechanism? Is that a possibility?
No.
Okay.
I don't think so. That's one of the sort of the core features and aspects of especially Bitcoin enthusiasts really seem to don't want to change, is that consensus mechanism. So I think we'll see enhancements for speed as it scales further, but I don't see it moving forward.
And what are your thoughts about exchanges like Binance that release their own coin?
Well, I think exchange tokens represent a lot of different promise, right? You're going to need, like, these types of exchanges are going to need their own token, right? It's almost like, I hate to use this analogy, but functionally it works. A casino. You exchange for chips from that casino that are worth an amount to do what you need to do with. But like, those exchanges are going to have their own, tokens by which you can have a lot more interoperability with that particular exchange, as well as then flip it back to Bitcoin or move it off the exchange if you so wish. The important part, though, is going to be the KYC and AML and compliance issue on onboarding onto these exchanges. I think is one thing that the regulators have made very clear that they're going to start to get a bit more tighter about, and that's better for everybody. Let's
see, we have some more questions. Let me see. A lot of them are coming in, so hang on. Is VChain a coin involved in supply chain?
Yeah, VChain is a token, and that's one of the core use cases that community is starting to promote.
All right. Any more questions? Oh, wait, hang on. I think we may have another one. One final one. Nope. Okay. I think we're ready to wrap up. Do you want to say some final comments?
Well, no, I just want to say thank you to everybody for joining. I can't wait for our next few sessions. We're going to have a handful of different speakers in addition to me hop on board. Yes, you do have to register separately. We're going to send everybody that attended today a registration link at least a few times so that you don't forget. And they will be available after the fact. But please join the live session if you can. And we're going to be sending out information to make sure that you can fill out your registration form so that you can reserve your spot. But thank you very much for everybody that came on today. Dara, thank you very much for hosting and moderating. And I look forward to seeing everybody in the next couple. And
thank you, Jahan. This was just a brilliant presentation. I really appreciate it. Everybody, yes, we'll have many more of these, and they will be an ability to watch this again. So we'll give you all the details following the presentation on access to the video, et cetera, and anything that you need also concerning CE. But feel free to reach out anytime if you have any questions, and we look forward to seeing you at the next one in 2 weeks.
Absolutely. Take care, everybody. See you next time.